Happy Thursday out there, Team 42. It's your skipper here, Darius Delta, present our macro minute for Thursday, February 6, 2025. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions, as well as what specific changes you need to make in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. So today's key macro question is, how will US Treasury net financing policy evolve over the medium term? Our answers are, in its Q1 quarterly refunding announcement, the U.S. Treasury Department assuaged our fears that U.S. net financing policy was on the precipice of a hawkish pivot that would complicate the global debt refinancing cycle. That pivot appears to have been meaningfully delayed as incoming Treasury Secretary Scott Bessent, who we believe was inappropriately critical of Janet Yellen's dovish net financing policy, appears to have had a change of heart now that he's the one responsible for the impact the Treasury has upon the economy and asset markets. Also, the Q1 QRA alleviated some of the concerns we had regarding the outlook for Treasury net financing policy. The decision to maintain and even reduce, in some cases, coupon auction sizes for the next several quarters implies Secretary Bessent is comfortable waiting on the outcome of the legislative process before making any big changes. An upside surprise in deficit reduction would allow him to increase coupon and bond supply into what he hopes are more favorable Treasury market dynamics late this year or early next year. With upwards of $500 billion of debt ceiling-induced TGA spin-down, Treasury General Account spin-down likely over the next few months, the Treasury's impact upon liquidity and asset markets should remain positive for a while, especially in the context of the debt ceiling reducing net financing to zero, which frees up investor balance sheet capacity to further capitalize risk assets. Transitioning to our 42 Macro dashboard here, as always, we're wrapping up with a question from our community. Says, hello, Darius. This is my first post in the chat, so hopefully this works. It did. My question is whether we can still rely on widening credit spreads as an early warning sign of stress in the financial system. I'm wondering if, with the great increase in private equity financing of companies, whether many poor quality companies are now receiving their loans outside of public system and therefore will not affect publicly visible credit spreads as quickly in the past. Some observers feel that there is clear evidence of deterioration in the U.S. economy that has not so far had a major impact on stock indices, but could use some of this could some of this economic deterioration and therefore worsening credit quality of many companies, quote unquote, be hidden within the private equity space. Publicly available credit spreads continue to be unusually tight, but I believe the latest information does show a bit of widening is starting to occur even here. Would appreciate your thoughts on this point. Thank you. The last part about a little bit of widening that we've seen. Yes, in fact, we have seen a little bit of widening, but not a tremendous amount of widening. Credit spreads are still, as the question suggests, are still relatively tight by historical standards. And I want to say that I think they're in the second percentile of daily data going back to the, I want to say, the late 80s on investment grade credit spreads. So very low, very tight relative to that. Going back to the question, I think there's something to be said about the growth of the private credit asset class as, creating an additional financing avenue for companies. We've also had a significant reduction in the overall amount of public companies. We've seen a lot of companies stay private for much longer, in terms of the growth rate of unicorns, et cetera, in the private equity and venture capital asset classes. So a lot of capital markets activity has, in fact, been shifted off balance sheet. Now, the thing I will say about this is when you're talking about credit spreads, to me, credit spreads are an indication of liquidity. They're an indication of the amount of balance sheet capacity out there for investors to take down new deals and to roll over existing debt financing and ultimately capitalize new net financing. So if there's any stress in the broader system that is actually weighing on some of these private companies, it would, in fact, spill over into credit spreads because ultimately that the liquidity that would cause a private company to struggle, the lack of liquidity that would cause a private company to struggle would also impact public markets as well. So I don't believe that credit spreads are a somewhat less useful indicator. I think they're just as useful as they've ever been. And what I think is really happening is investors have just been dead wrong about our resilient U.S. economy theme for 2+ years. I mean, that's just simple as the fact of the matter. I mean, everyone's turning over stones, and I'm not accusing the client of this, but this is what I've noticed in terms of the bear porn. I mean, I still scroll YouTube and Twitter and see, the large share of bear porn that's out there that, hasn't really gone down as much as I would have thought, given the fact that we've had two back-to-back 20+% of years in the S&P 500 that we were on the right side, that we kept our clients on the right side of. So in my opinion, I think what's happening is people are now getting exasperated and frustrated and looking at things like private credit and whatnot, the stuff that they can't see, and blaming that as opposed to just acknowledging that liquidity conditions are relatively okay and credit spreads are tight because the economy's fine and there's no real need to price in a credit cycle. There will eventually be a need to price in a credit cycle or a significant reduction in liquidity. But we're not there yet, and so I would just caution all investors to respect the x-axis on some of these dynamics. There will be a time to manage risk in a significant manner, and knock on wood, Lord willing, our KISS and Dr. Mo signals, which have been awesome, will continue to help clients stay on the right side of market risk, irrespective of whether we're in a bull market or bear market. So that is what it is on that. So great question. Hopefully that was helpful, and we'll get you back here tomorrow. We will have our February. We're in February. Oh my God, this year's going by so quickly already. We'll have our February 2025 monthly macro scouting report presentation out tomorrow afternoon. That's going to be jam-packed. I really don't think you're going to want to miss this one. Just given the wide and widening distribution of probable economic outcomes that is being driven by the wide and widening distribution of policy outcomes here in the U.S. when it comes to fiscal policy, regulatory policy, trade policy, and ultimately how all that's going to impact monetary policy. So if you want some pros to help you piece all those puzzles together, then definitely check out our February 2025 macro scouting report tomorrow afternoon. So wrap it up there. Everyone have a wonderful day out there. Best of luck. Catch you back here tomorrow. Cheers.